Forget everything you know about APY hunting or chasing yields. I'm about to show you what the top 1% of DeFi investors use to build wealth within this bull run. This is the same strategy that I've used to make hundreds of thousands of dollars in decentralized finance, but also on my current positions be up $8,700 and at a $500 profit compared to just holding in the market, even when we're seeing super high volatility in the market today. And as mentioned in my previous video, the same strategy that we use to have a fallback option whenever we are losing compared to holding in the market, like this position right here. Now, long story short on that, we essentially use the income generated by these DeFi yield generation positions, and we essentially buy up the asset that we have in the position. So this is Ethereum to Aave. In this instance, Aave outperformed Ethereum. But the thing is, we had already pocketed the majority of the income from the following positions to the point where I was able to build up a bag of about $1.5 grand of Aave token. And when Aave outperformed Ethereum, that $1.5 grand went up to about $2,000. $500 profit right there. $500 outweighs $409. It's all about building a portfolio, not building a position or a strategy. A portfolio is comprised of multiple strategies, which is comprised of multiple positions, which is comprised of multiple assets. It trickles down. So that being said, this framework is called the DeFi formula. It's a proprietary strategy that we've been building since February of 2023. The fundamentals and philosophies have not changed. The method that we execute it has. And the reason why is because we've spent hundreds of thousands of dollars investing into software and other resources that allow our members to go through this roadmap with ease, as opposed to having to have a bunch of spreadsheets or a bunch of resources that are all over the place. We've only made it easier to progress. With that being said, the DeFi formula is a strategic framework for building sustainable DeFi portfolios, as opposed to chasing high yields and getting burned, investing into assets that are depreciating, or of course, witnessing a bunch of divergence loss in your portfolio. And of course, we are not just pulling this out of our behind. We have years of market experience, as well as we have worked with investors that have millions of dollars in the DeFi markets, build up their portfolio and mitigate any divergence loss. I'm going to give you a high level overview of each phase, and then we're going to dive deep into each phase as well. And if you guys do want to follow along, I'm going to leave this document linked right below this video if you guys want to check it out. First phase is the blueprint phase. This is exactly where we write our blueprints. Basically, we plan out our portfolio. I like to use the example of a skyscraper. You cannot build a skyscraper without blueprinting, right? And then we move on into the construction phase. We have to construct our skyscraper, but the first thing that we construct is our foundation. We build a rock hard foundation, basically, of solid concrete with steel bars in between. And then we start to build up the skyscraper by finding different DeFi positions. And of course, as you probably know, there are some buildings that launch, or rather open to the public, when it's not fully finished. That way they can start bringing in money. That's exactly what we do in the launch phase. Even though the portfolio is not finished, even though there's always more work to do, we launch the portfolio and we start earning income with a smaller amount of the capital allocation, as opposed to putting it all in at once. Then we start to manage, make sure that people are actually liking what they see, and then based on their feedback, based on our position's performance, and based on the analytics that we have so far, we start to build out the other sectors of the skyscraper. Or in this instance, we start to build out the other sectors of our DeFi portfolio based on what's working and what's not working in our portfolio. And then of course, we have the scale phase. This is where we finish building the skyscraper. It's now the tallest it can possibly be, but there's always renovations to do within that, right? Well, this is where we get fully deployed with all of our capital into the portfolio. We have confidence in our portfolio, and then we move on to actually scaling the portfolio and making sure that we're bringing in the most money, or in the instance of the skyscraper, bringing in the most customers and the most clients or the most residents, whatever it may be. So that being said, this approach right here is a business approach. It is not gambling. Now, I don't want to call this a DeFi business, and the reason why is because it's not a DeFi business. I am running a DeFi business called Builder Wealth, and I also have another DeFi business called Metrics Finance, where we are a business within the decentralized finance industry, helping onboard more investors like yourself into decentralized finance. Whereas this right here is just a DeFi portfolio that we are running like a business. Another example could be, if you've ever heard of LLCs, limited liability companies, you can have an LLC, have the benefits of an LLC, but elect to be treated as an S Corp. An S Corp has a ton of tax advantages. Whereas if you were to go actually set up an S Corporation, you have all this pain in the ass stuff that you have to do, because now you're a corporation, not just an LLC. What we're doing with DeFi is we're treating our portfolio like we would treat a business. We're working on our portfolio like we would work in a business. But at the end of the day, it is a portfolio. It is not a business. And that just comes with the approach of not gambling away our money into high APY stuff or meme coins or anything along those lines. Now, that being said, I want to go ahead and talk about the blueprint phase and talk about what we're actually doing here. First things first, goal setting and capital allocation. allocation. We want to make sure that we have a clear idea of what our goals actually are with this portfolio, how much income we want to generate, how much capital we're going to end up deploying, when we are going to deploy that capital, because we don't want to deploy it all at once. We do a risk tolerance assessment so we can see what type of risk level you have. It's the first thing that you need to determine. What type of investor are you? Are you a high risk investor, mid risk investor, or low risk investor? And what does that mean to you? Because I had somebody comment on my YouTube video the other day, hey, you're a mid risk investor, but you're investing into crypto. And I'm like, hey, I'm a mid risk investor in crypto. I'm a high risk investor in the real world, right? Because those things mean different things to different people, basically. We also established the timeline for actually building out our portfolio, what that's going to look like. Highly recommend you go through each phase on a week by week basis. So that way, within 5 weeks, you're already at the scale phase. We schedule our capital deployments, like what dates we want to deploy more capital, what we need to achieve in order to deploy more capital. And then after that, we dive into the portfolio architecture, where we select positions, we start to evaluate different protocols, and of course, we implement a risk management framework. This is the blueprint phase. We're not diving deep into different strategies that we can find, like using metrics finance or anything along those lines. That's exactly what we do in this construction phase. Within the construction phase, we start to find different positions. Now, full disclaimer, how do we find different positions? We use metrics finance, the proprietary software that we spent over $100,000 building. The reason why we use metrics finance is because there quite literally is no better software out there, at least that we found. We found other ones like Crystal, like Aperture, like Poolfish, other tools, but they typically do not provide the results or the data that Metrics Finance does provide. And yes, we do have a biased opinion because we did build this software, but there's a free 5-day trial out there if you guys want to try it out and also try out those other tools and compare to see what's better. Because I highly recommend that you use what works best for you, even if it isn't Metrics Finance. Yes, we'll be sad that you're not using Metrics Finance, but we'll get over it. But we have a framework for making sure that you're in the right protocols as well as you're selecting the right positions. Part of that framework is just filtering, making sure that you're looking at not 532 opportunities over here, but maybe like 100, 200 max or so. So that way you don't have to spend a bunch of time on a bunch of junk, in all honesty. One of the main things that we like to do is filter by TVL, do above $1 million, but this right here can be changed, right? If we're not finding results at above $1 million, we'll adjust this to 500K, then 250K. It's going to be completely different depending on if you're on Uniswap or QuickSwap or Orca or something along those lines. But after you do that, you're going to start to sort through these different pools over here, which we'll bring into the simulate page a little bit later on in this framework. We look at the risk adjusted returns of investing in these different positions. Next thing we do is simulate the performance. So that's going to look something like this. If we're diving into Ethereum to USDC, we're looking at this liquidity distribution and how it performs over specific periods. We're also looking at specific ranges, like what happens if we were to do a range like this as opposed to a broader range. Oh, well, the APR is significantly higher. We also look at the 30-day volume history and see, oh, this is declining. It doesn't make sense to be standard like all the other protocols and just factor in 30 days of volume. It makes sense to look specifically at these 3 days right here where we're doing consistent volume, in which we would determine we're no longer doing a 55% APR, we're doing a 35% APR. And then from there we say, okay, well, what happens if Ethereum goes to $4,200? Well, now we're nearly out of range and we have roughly $16 of divergence loss, in which we would need 18 days of yield to cover that, basically. That's not that good of a position in my personal opinion. We would scratch that off the list by using this framework. Next thing that we have is the launch phase. This is where we open up the first position or first 2 positions, however many you want to deploy this phase. But we do the first chunk of capital, basically. We plan out our deployment. We optimize the entry time. So we try to find a day where the market is dipping so that we could get in at a good point in time. We also make sure that if we're using the Ethereum network, like I'm personally using and making thousands and thousands of dollars per month, that we are entering at night. So that way we are not spending thousands and thousands of dollars per month in gas fees. I'm personally spending about $200 per month in gas fees. That's because I have longer term positions. I transact at night. And of course, my positions are generating substantially higher returns and they're not generating those returns on other networks. We figure out our position sizes. This is actually pretty easy. You just determine how much of each asset you want allocations to at the start. Like, hey, I want 10K of Bitcoin. Well, if we have a wrap Bitcoin to USDC pool and then a wrap Bitcoin to ETH pool, we determine, okay, well, there's going to be 5K Bitcoin here and then 5K Bitcoin in that pool. And then boom, that's determined. And then of course we deploy our capital to the different platforms and smart contracts, and we are done with the capital deployment for now, because it's never done. You always have to deploy more capital, whether it's rebalancing or whether it's bringing in new capital. There are always optimizations to be made. Then we move into the management phase, which is where we do active monitoring. We look at key performance indicators like that versus HODL number that I've been mentioning over on Metrics Finance. Right over here, you can see I'm at a $518 profit compared to holding in the market. We make sure we're tracking our risk to make sure that our risk isn't going up over time while our yield is going down over time. Something that a lot of people forget. You always need to reevaluate your positions to make sure that they are still fitting the initial criteria that you entered with. For example, these positions that I've been in since November 25th and this one down here, November 16th, a lot can change in 2 weeks, which is why I'd want to reevaluate it after 2 weeks or after a week and make sure that it's still fitting the overall strategy. And then of course, rebalancing triggers. We are setting price points that we know we want to rebalance at. Yes, we could use automations, but then we spend money using those automations and it cuts into our yield and cuts into our profit versus holding in the market. So sometimes we just want to set price alerts and get notified whenever we need to rebalance. We create our profit taking strategy knowing when we're actually going to take profit. And of course, we have a protocol for managing any losses that we have and managing any divergence loss like this. And in this example, we use the income to outweigh all the divergence loss because we converted the income into Aave token. And then of course, we have the scale phase. This is where we're now implementing business systems, but into our portfolio. We're electing to treat our portfolio like a business now, basically. So if that means automation and the automation makes sense, then yes, that's where we would implement it. But we are always running backtests. We're simulating potential returns after we factor in fees. We're looking at the time input difference compared to the fee difference that we are paying basically and saying, hey, we are saving 2 hours of time, but we are paying $100 more fees. And if those numbers don't make sense to you, then don't implement it basically. Keep going manually. We have reporting frameworks for making sure that we have reports on our portfolio, whether it's through Coinly, which is tax tracking software, but is the absolute gold mine for tracking your portfolio profit loss and income that you're generating. We also dive deep into these positions, not just look at this versus HODL number, but look at this divergence loss table. And you could see we're at a profit compared to holding 50-50, at a loss compared to holding initial assets, at a profit compared to if we just stuck it all in Ethereum, and at a loss compared to if we held Aave token. And of course, we expand. If we're just on one network or if we're just on one exchange right now, we want to broaden the scope, whether it's investing over on Orca, on the Solana network, or Radium, we start to expand over there. Additionally, we start to bring in new positions. So for example, if we deploy like 2-3 positions in launch phase and we want another 2-3 positions, that's where we would do it in the scale phase. And we always look at this right here. How can we take lower risk while still making the same return or still making a better return basically? And that's all part of scale as well. So this right here is the DeFi formula. Now, a couple things that I want you guys to keep in mind for your success: data-driven decision making. This is the most important thing you can do. Businesses that succeed, they do not have sloppy data. Portfolios that succeed, they do not have sloppy data either. Risk management always comes first. Make sure that you are not taking more risk than what you are comfortable with. Have a systematic approach, whether it's this DeFi formula or some other random formula out there or some other proprietary roadmap. It does not matter. Make sure that it's systematic. Make sure that you're actually following one that seems to make sense to you. And if this doesn't make sense to you, don't implement it. And of course, continuous monitoring. This is not a set it and forget it opportunity, and have professional tools by your side. And that's exactly why we built Metrics Finance. That way you can have the most accurate data right at your fingertips as long as you know how to use it right. But also you have a good idea on what type of returns you can earn before entering. And when it comes time to track performance, you have a good idea on how you are actually performing. So with that being said, if you guys are thinking, well, this looks great, but how do I actually implement this? Or what if I make a mistake? Or what if I need some more guidance? Or what if I need somebody to literally walk me through this roadmap? Then I highly recommend that you subscribe to the channel, but make sure you turn on notifications when subscribing so you get notified about my next video. Additionally, you can access this document right here so you can kind of follow along as I explained in this video. It's also right below this video in the description. And to just show you that this framework actually works, this is Jason right here investing into AVAX to USDC, earning roughly $1,500 in the time span of 7 days. His deposit wasn't 100K, it wasn't 50K, it was $16,000 that he has in the position. We also have a NOS, which is generating roughly a 370% APR on his first deployment within Ethereum to Pepe. And we have Mitch right here averaging out to roughly a 337% APR on his entire portfolio, being up $21,000. So now you've seen the power of the DeFi formula framework. I've personally used this same framework to generate hundreds of thousands of dollars in the decentralized finance industry. Our clients have used this framework to generate hundreds of thousands of dollars per month in the DeFi industry. With that being said, I bundled everything from this video up into that one single document, which is going to be linked right below this video, so that way you guys can follow step by step exactly what you need to do to implement the DeFi formula. And if you guys are looking for further support implementing the DeFi formula, we are going to have a video coming out within the next couple days, providing you with an opportunity to actually work directly with ourselves implementing the DeFi formula into your portfolio, so that way you can quit your 9-to-5 and consistently generate passive income. I hope you guys enjoyed today's video. Once again, subscribe, make sure you turn on those notifications so you get notified on our next video and any future videos that we have. And I ask you to comment down below what the biggest challenge you're currently having in DeFi is right now. And then of course, I'll see you guys in the next video. Peace out.